Investing money is a powerful means to foster wealth accumulation, particularly over an extended period of time. However, novice investors often find themselves susceptible to various pitfalls that can impede their financial progress. These pitfalls, commonly referred to as behavioral biases, encompass both cognitive and emotional tendencies. Biases are subconscious predispositions that influence our thoughts and behaviors in specific situations. Given that investing involves incomplete information and an array of probabilities, investors can easily fall prey into these biases. So today, I'll take you to investment traps that could wipe out your wealth. If you're new to the channel, hit that subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. Number 1. Sunk cost trap. The sunk cost trap involves a reluctance to abandon past decisions, even when they prove detrimental to your investment. It stems from the inability to accept the wrong choice has been made, leading to financial losses. This trap is akin to holding onto underperforming stocks, hoping that their prices will eventually rebound. By doing so, investors protect their original decision to purchase and hold on to these stocks, which can have adverse effects on their portfolios. When faced with a struggling investment, it is advisable to cut losses early and seek more promising alternatives. Accepting the loss or acknowledging a poor decision is made often is difficult but necessary. If an investment fails to yield expected returns, it is prudent to move on before the asset's price declines further. It is crucial to avoid emotional attachments to your investments to facilitate easier divestment before the situation worsens. Setting clear investment goals can aid in sidestepping the sunk cost trap. By establishing performance targets for portfolios, investors can reassess their strategies and make necessary improvements to achieve better returns. Number 2. Anchoring trap. The anchoring trap involves an excessive reliance on initial beliefs or perceptions. It occurs when individuals cling to the notion of an asset's original value, leading them to make misguided decisions. For instance, an investor might perceive a particular company as successful and assume that purchasing its stocks is a wise choice. However, this perception may no longer hold true in the present or the future. Similarly, an investor may hold onto a stock for too long due to anchoring on the initial purchase price, even when it should have been sold earlier. To evade the anchoring trap, it is crucial to maintain an open mind and remain receptive to new sources of information. Recognize that a company's present success does not guarantee its future performance. While some factors can mitigate anchoring, it is challenging to completely avoid this bias, even when one is aware of it and consciously tries to circumvent it. Always bear in mind that the past performance of an investment does not guarantee its future outcomes. Conduct thorough research, including analysis of the asset's price history, to better understand its future performance. Be open to new investment information that may challenge your initial perception. Number 3. The superiority trap. The superiority trap, also known as the overconfidence trap, is another behavioral bias that plagues many investors. Overconfidence leads individuals to believe that they possess superior knowledge compared to experts and the market itself. Merely having a strong educational background does not render one immune to benefiting from insights and advice from others. It is worth noting that those who fall victim to multiple investment traps are often the same individuals who exhibit unwarranted overconfidence. Investors trapped in a state of superiority hold inflated views of their own abilities and investments. They excessively rely on their own judgment, often disregarding valuable advice that could potentially save them from errors. Such investors may become reckless, assuming that they know better than the market. Even if the stock continues to decline, they remain optimistic, hoping that the market will eventually recognize its value and drive its price higher. However, if the stock continues to falter, these investors may eventually be forced to cut their losses and exit their positions. Excessive confidence in one's investments can lead to a lack of precautionary measures to protect investment capital. Overconfidence may lead to poor decision-making, resulting in excessive risk-taking and inevitable losses. It is essential to recognize the limitations of individual knowledge and expertise. By humbly acknowledging the potential for error and seeking advice and guidance from professionals and experts, investors can mitigate the risk associated with the superiority trap. Implementing proper risk management strategies and avoiding excessive risk-taking can help safeguard investment capital and prevent costly mistakes. Number 4. Pseudo-certainty trap. Another significant trap in investing is the pseudo-certainty trap, often referred to as loss aversion. This bias revolves around an investor's perception of risk. When investors anticipate positive returns, they tend to limit their exposure to risk. However, when faced with potential losses, they become more inclined to take risk in an attempt to recover their capital rather than generate more. Loss aversion occurs when the fear of losing money outweighs the potential for gaining money through an investment. It manifests when investors are unwillingly to take risk to avoid incurring losses. While it is true that all investments carry some degree of risk, some are riskier than others. Succumbing to loss aversion can hinder opportunities for profit, as investors become overly concerned about preserving their investment capital. Undoubtedly, excessive risk-taking can lead to disastrous outcomes, but being too risk-averse can also be detrimental. To navigate this trap, it is essential to develop a sound investment strategy that balances risk and potential rewards. Emotions should be kept in check, allowing for some discomfort when making investment decisions. By carefully evaluating assets with a solid track record, investors can make calculated choices and optimize their investment portfolios. By the way, if you're enjoying this video, please take a moment to like and subscribe. It really helps us spread the Thrive Wise love, so we can help more people thrive wisely. And going back, number 5, confirmation trap. The confirmation trap occurs when investors seek and pay attention only to information that aligns with their existing beliefs. It can also occur when individuals repeatedly seek advice from sources that have consistently made the same mistakes. Rather than critically evaluating different perspectives, investors may cling to the advice of those who confirm their preconceived notions. This biased approach overlooks contradictory information, leading to poor decision-making. Confirmation bias fosters overconfidence and contributes to irrational behavior in the market. It reinforces the argument that the market is inefficient and further explains why investors do not always act rationally. Overcoming information bias begins with recognizing its existence. Investors should actively seek alternative views that challenge their preconceived notions, opening themselves up to a broader range of perspectives. This approach cultivates a more objective and well-rounded decision-making process. Number 6. Fear of missing out. The fear of missing out, also known as FOMO, is a trap that often leads investors to make impulsive decisions without thorough consideration. It is closely related to the follow-the-sheep behavior, where individuals blindly follow the actions of others without conducting independent analysis. Rather than making informed decisions based on their own research, investors succumb to the temptation of mimicking the investment choices of others, particularly when they see their peers or acquaintances heavily investing in a particular asset. The FOMO trap arises from a fear of being left out and a desire to capitalize on potentially lucrative investments. Investors may disregard their own due diligence and rational thinking instead of opting to join the herd. This behavior was especially prevalent during the dot-com era, when numerous investors bought into companies with weak financial models simply because others were investing in them. Following the crowd may give investors a false sense of security, as they believe they are making the right decision by aligning with popular trends. However, it is crucial not to rush into investments without conducting thorough research and assessing the company's fundamentals. Number 7. Irrational exuberance trap. The irrational exuberance trap refers to the tendency to hold an inflated assessment of one's skills and intellect. While confidence can be an asset to various situations, it can become a weakness when it comes to investing. Investors often fall prey to the belief that past performance guarantees future outcomes, disregarding the inherent uncertainty of the market. They may assume that what happened before will inevitably repeat itself, failing to recognize the cyclicality and volatility of investments. Overconfidence can lead to greed, causing market bubbles to eventually burst with significant corrections. Those who exhibit excessive confidence and invest heavily just before a downturn are the ones most adversely affected. If you are new to investing, it is advisable to seek guidance from experienced professionals who can help develop a sound investment strategy that maximizes profits while managing risk. Relying on the expertise of others can provide valuable insights and prevent falling victim into overconfidence bias. While investing inherently involves risk, falling into these investment traps can make investors feel even more vulnerable. Conducting thorough research, relying on diverse sources of information, and developing a personalized investment strategy are essential steps to protect oneself from these pitfalls. By following these tips, investors can enhance their decision-making processes, safeguard their time and money, and navigate the complex world of investing more effectively. Well, that's basically investment traps that could wipe out your wealth. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.